this is Mindy Strong. I am helping you prepare for the Series 65. Today we're going to talk about portfolio management styles and techniques. All right, here we go. First of all, there's a major decision that needs to be made. Are we going to choose equity investments, interest-bearing investments, and in what ratio, what proportion are we going to do that? So let's look at debt versus equity. So debt, also known as interest-bearing, has some favorable aspects, characteristics. They have a lower credit risk. There's no volatility. It's a fixed income. It does have market risk, and it does have purchasing power risk. Equity investments, on the other hand, have a higher credit risk. They have greater volatility of return. However, they tend to be faster with growth, and they can combat inflation a little bit better, and they can combat purchasing power risk as well. The time horizon is something that certainly should be considered when looking at those two, debt versus equity. Do you have a long-term horizon? Well, in this case, inflation is the greatest risk, so equity investments are going to be better. On the short term, equity returns can be very volatile, as we just saw in the short term, and they can even be negative. So interest-bearing or debt investments would be better for short term. So before I move on, let's think in terms of a human being. If this human being is 25 years old, then we can look at more equity investments. They have a long time to get prepared to make that money. Whereas if you are looking at someone close to retirement, we're going to be looking at safer, more short-term, less volatile investments. Asset classes. Asset classes involve the following 5: stocks, bonds, cash, which are also known as money market instruments, real estate, and commodities. When creating a portfolio, there are 4 components that should be considered, but there are 2 specifically that are arguably the most important. One, which asset classes of the ones we just looked at? And number 2, what target percentage of each asset class should be included? Number 3, of less importance, the allowable range within each asset class in order to maximize the intended results. Number 4, selection of securities within each asset class. So we kind of narrow it down. First, what asset classes are we looking at? And then we narrow it down a little bit. What are the target percentages of each class? We narrow it down a little bit more. What's the allowable range of these target percentages we're willing to deal with? And then specifically, which securities meet all of those requirements? Here's an example of a traditional portfolio. You've got government, U.S. government bonds, you've got long-term corporate bonds, and you have large company stock. And that goes from conservative to more equity and riskier, more volatile. There's something called strategic allocation and there's tactical allocation. Strategic allocation is targeting the percentage of each asset class, which we just mentioned. This is where you select the portion to be invested in different securities, which is called the portfolio balance or the normal asset allocation. Normal, that's sort of your baseline. The tactical asset allocation is also known as the dynamic asset allocation. Dynamic means movement, right? So there are minimum and maximum limits that are set for each asset allocation, and the managers are going to shift those allocations based on the market. Selecting the assets and the securities. Well, there are 2 ways these can be managed. There's active asset management and there's passive asset management. Active asset management involves a fundamental analysis that can identify undervalued securities. They look for inefficiencies in market pricing. This is an expensive process. And of course, these market returns are expected to exceed the market returns. So, I mean, you're paying a management fee, right? And you're expecting this person to do better than, and you're paying a fee to do it. So they're looking for inefficiencies and trying to do better than an index. Passive asset management is essentially the thought that the market is efficient in pricing securities, and an index fund can be used for each class and do just fine. We have seen this in other videos I've created. I added a few in here, but essentially we're looking at the standard deviation versus the rate of return, and we are looking at how risky something is. So standard deviation, think of that as the interest you're expecting to get back. Obviously, it is proportional to the amount of risk. So treasury bills are going to be the safest, and you're going to expect the least return. Treasury agency and treasury bonds are next, international bonds. And then we get to our stocks: large cap, mid cap, small cap. Then we have our international stocks. And we have our REITs and our micro cap stocks. There are some popular indexes you should know about. The Dow Jones Industrial Average is the 30 large cap company issues, mainly on the New York Stock Exchange. The S&P 500 is the 500 largest market cap issues headquartered in the U.S. Value Line Index is 1,700 stocks, followed by the Value Line Investment Survey. Mainly, these are large cap. Wilshire Index is 3,500 common stocks. The Russell 2000 is where we look at the small caps. Those are 2,000 small cap funds. And then we have the European Australasia Far East, EAFE for short, index. And these are large stocks outside of North America. There's something that everyone receives called the investment policy statement. That is the summary of what can be expected from the strategy chosen. So I have a little chess piece there showing you what can be expected. These are the moves that can be expected. Portfolio rebalancing. Okay, we're going to look at rebalancing and we're going to look at managing, and we're going to compare them. So reallocating money from overperforming assets to underperforming assets is what rebalancing is all about. There are two ways in which this is done. It can be annually rebalanced, and that's said to be passively rebalanced. So once a year, everything is rebalanced within those target parameters, or it can be rebalanced monthly. And if so, it's actively rebalanced. Now, you may see something in which we are looking at the rebalancing and the managing of a portfolio. So if you see two words, whether it's active and passive, the first has to do with what style of rebalancing. So for instance, in this example, active and passive, you have something that's actively being rebalanced. That means monthly. But it's passively managed, so it's probably an index fund. Make sense? So the rebalancing will be the first part, and the managed aspect will be second. Buy and hold is a strategy, but it's not a good one. This would increase the portion of a portfolio held in equities, and then a bear market comes and it minimizes the portion of the portfolio held in the equities as a bull market is entered. It is not something that should be done long term. This is a short-term strategy. And here we go back to looking at passive portfolio rebalancing and active. I wanted to describe this in more detail. So passive, continually reallocating from over to underperforming to maintain the balance. It's set at a time interval. Often it's monthly. It's very frequent. Active portfolio rebalancing. The manager decides where to reallocate the funds. The manager uses market timing. Generally, this is done once a year. Passive is generally done once a year, and active is done on a more regular, like a monthly basis. Sorry, I flipped those around. Active obviously is done more often, and passive is just kind of like a set interval once a month or so. But active can be looked at a set time. Sector rotation. It makes sense that different sectors tend to do well at different times in the business cycle. Technology tends to do well during early expansion. Industrials tend to do well during late expansion. Consumer goods do well during the peak. Telecoms, utilities during early recession, and financials during late recession. This is good to know because we can make selections accordingly. Diversification. Within an asset class, allocation should be made based on risk tolerance and diversified accordingly. It is very important that risk tolerance come into play. Whoa. Let's go back. There we go. Okay. Sorry about that. Okay, index tracking error. So in this case, managers who want to track an index must do better than the index to cover the fees. They have to do better, and there is something called the tracking error. It refers to underperforming the index. Many managers use passive and active management styles. Positive tracking errors have to be greater, and the active rate of return comparing it to a benchmark, usually an index. The benchmark is also the passive rate of return. So if we're not paying anybody to manage our portfolio, then we could use the S&P 500. You've got to do better than the S&P 500 and more than cover your costs in order for it to make sense for us to pay you to manage. So then you would compare your results to the benchmark, and that would be the tracking error. Okay, financial leverage. Borrowed funds to increase the amount you're investing is sometimes done. That's called financial leverage. However, the funds must be borrowed at a lower interest rate than the return you're receiving. Duh, makes sense. Bond portfolio immunization. When you immunize, you protect. When you use a bond portfolio immunization, you create a portfolio worth a specific amount on a future date. So I need this to be worth $20,000 in 5 years, as an example. This eliminates the interest risk, and the duration of the bonds in this case must match the length of time until the money is needed. Duh. Totally makes sense. Bond contingent portfolio immunization. Now in this case, bond contingent portfolio immunization. Contingent means based on, as long as. Active management strategy is used where the manager tries to choose bonds that will outperform a benchmark. But if it is not outperforming that benchmark, if it drops below, then they start using a defensive strategy. So you can see here I used two images. So they have this management strategy. They're trying to choose bonds that are going to outperform, but they might have to switch their strategy to a more defensive if things aren't working out for them. Investing. There's growth and there's value. Growth is when selections are made based on earnings growth or stock market price growth over time. Value is looking for securities that are currently undervalued in the marketplace. This strategy is usually used with investing by looking at price earnings ratio and price book value ratio, then the current products, new products, management, the value of the company. Growth is just how much is this going to grow? Value is let's look at the company as a whole. Let's look at the price and earnings ratio, but let's also look at where is this company going? Now there's momentum and there's whisper numbers. These are two concepts. The theory of momentum is where investors believe that once stocks start moving at high speeds, they're going to continue moving rapidly in that same direction because they have momentum. Pretty dumb. Duh. Not dumb. Pretty obvious. Whisper numbers. Now this is where you're going to look for the signs that trends are about to take hold. And the whisper number is the expected number. When it goes higher than that whisper number, you buy the stock. So you're waiting and you know that a certain number indication is there. It's coming. And once it does, boom, you jump on it and you buy the stock. Whisper numbers. Funding techniques. The actual purchases have to be made at the right time. Duh. This is huge. Lump sum funding is when everything is bought at the same time. All my chips on red. Everything is bought at the same time. You must have a high risk tolerance if you want to use the lump sum funding technique. The opposite of that is dollar cost averaging. It's taking a fixed dollar amount to be invested periodically, and you fund it slowly over a year or so. This reduces volatility of return. It's great for common shares. You can buy them low. This is a tortoise versus hare kind of situation here. Timing for funding. Generally speaking, common stocks are funded over 12 to 24 month period. Takes a little bit longer when you're funding something with common stocks. Bonds are generally funded over 3 to 9 months. Shorter time frame. Reinvestment. Reinvesting the dividends or the interest is going to increase the dollar cost averaging. That makes sense. Reinvesting the capital gains also has the same effect. There's something called a dividend retirement plan, shortened to DRIP. You can reinvest your cash dividends into more shares. There are no commissions that have to be paid. This is a dollar cost averaging reinvestment strategy, but you can't determine when it's going to be purchased, and this is offered by issuers. So it just happens periodically. The dividends can be reinvested into more shares, but you just can't determine when that's going to happen. But it does have the effect of dollar cost averaging. Okay. Purchase price and price per share. The average price per share is determined by taking all prices of stock and averaging them. Duh, right? Let me say it again. The average price per share is determined by taking all of the prices of the stock and averaging them. The average purchase price per share is determined by dividing the purchase price by the number of shares. You add those together and divide by the total amount spent. So this one takes a little bit more work to figure it out. And typically the purchase price and the price per share are going to be the average purchase price per share and the average price per share are going to be a little different. Okay, but the average purchase price per share is more accurate. And that is the end of this section. I hope this has been helpful. Let me know.